Welcome to the debate. Last year, a single AI-generated trading strategy went completely viral on social media.
Oh, right. The one promising a 233% return?
Exactly. 233%, and it boasted this near-perfect 99 trade win rate. And, I mean, it took a user maybe 10 minutes to build, but under the hood, it was entirely a mathematical illusion.
And that illusion isn't harmless. It is part of a much wider, rapidly expanding ecosystem that drained nearly $1 billion from retail investors in just a single year.
Which brings us to the core of our discussion today, the intersection of retail finance and artificial intelligence. As large language models, or LLMs, become universally accessible, retail investors are trying to use them to generate quantitative trading algorithms.
Right. And at the exact same time, our social media feeds are just being flooded with AI-driven investment advice, platform-affiliated Finfluencers, and purported high-yield bots.
So the central question we are exploring is this. Are large language models fundamentally democratizing algorithmic trading for retail investors by bridging that highly technical coding gap?
And this is where I lean. Are these systems mathematically and structurally unsuited for financial forecasting, effectively accelerating wealth destruction and fueling a predatory ecosystem?
To unpack this, we are grounding our discourse in recent academic frameworks, specifically the FinSab study.
Along with industry data from the National Anti-Scam Center, ASIC, and technical postmortems from quantitative developers who have actually reverse-engineered these viral AI strategies.
I will be arguing that LLMs, when they are strictly constrained by human expertise and rigorous out-of-sample validation, represent a profoundly powerful democratizing tool that bridges the gap for retail quantitative traders.
And my position is that LLMs inherently lack the reasoning required for dynamic market regimes. They tend to hallucinate or curve-fit historical data, acting as engagement-optimized black boxes that empower scams, not retail investors.
To start, I think we really need to separate the tool from the user, because the prevailing narrative out there is that AI is just fundamentally failing at trading.
Because it is.
Well, I'd say when you look at the technical postmortems, it's predominantly a framework problem, right? Not a fundamental technological ceiling. Take coding, for example. We know that LLMs struggle to write scripts for proprietary languages like TradingView's Pine script.
They struggle massively.
They do, but it's crucial to understand why. It's not because the AI is incapable of mathematical logic. It's because it is frozen in time by its training data.
Right, there's a hard cutoff date for what the model is actually read.
Exactly. So a platform updates its coding language from version 5 to version 6. The LLM's training data only goes up to version 5.
So it guesses.
It tries to guess the new syntax, and it fails. It hallucinates. But quantitative developers have already solved this by using a model context protocol, or an MCP server.
Which basically acts as a bridge to current documentation?
Yeah, it's essentially giving the AI an open book test. Instead of forcing the model to guess from its pre-trained memory, an MCP server feeds the AI the actual current version 6 documentation in real time. The AI is forced to read the rules before it writes a single line of code. And when you provide that structural guardrail, the models generate highly functional scripts. Plus, any logical errors can be systematically filtered out using proper backtesting methods, like walk-forward analysis. So my thesis is simple. The tool works perfectly, provided the user knows how to properly calibrate it.
I see why you'd frame it that way, but calibrating it assumes the tool is designed to seek the truth. And mechanically, it just isn't.
What do you mean?
I mean, I view LLMs as structurally incompatible with true alpha generation because they suffer from context rot, and they're optimized to please the user, not to uncover empirical market realities.
But they just process data.
Let's look at recent evidence from the AI research firm Sentient. They explicitly classify these models as engagement-optimized black boxes. The underlying architecture is literally designed to predict the most satisfying next sequence of words based on your prompt.
Right, the objective function.
Yes, If a user asks for a highly profitable trading strategy, the model will output code that looks incredibly profitable on paper, even if that output relies on flawed logic that leads directly to financial loss. It just tells you what you want to hear.
But that's a user error, asking the AI to magically invent alpha. Let's break down the actual code generation first. You're arguing that the AI fundamentally fails at translating market dynamics into algorithmic rules.
Yes, and we have stark public evidence of this. Take that highly circulated post recently in the TradingView community on Reddit. A user spent hours trying to get an LLM to code a fairly basic strategy.
Oh, I read that thread.
Right? And eventually, the AI explicitly admitted its own failure. It generated a response acknowledging that its scripts were, and I quote, overly complicated, too restrictive, or simply didn't work.
It reached a failure state and stopped.
It basically threw its hands up. It admitted it was consistently filtering out obvious trading opportunities that a human could clearly see on a chart. If the neural network itself is warning users that it cannot abstract market dynamics into reliable code, why would a retail investor trust it with their capital?
I get that skepticism, really. But let me give you a different perspective, because we have to look at the prompts those users are deploying. Retail traders are feeding the model impossible prompts like, make me a billionaire in 5 years.
Well, sure, which is mathematically impossible without catastrophic risk.
Exactly. You are asking a language model to invent a proprietary trading edge out of thin air. Look, AI is an intern. It is not a prophet.
An intern?
Yeah, it requires the senior developer, the retail trader, to supply the foundational trading edge. The human has to say, here is the exact market inefficiency. Here is the logic. Translate this into syntax.
I'm sorry, but I just don't buy that. Even when the trader supplies a valid edge, the code it produces is fundamentally flawed.
Not if you use the MCP server mechanism we discussed. You use multiple AI passes. One AI reads the version 6 documentation and writes the logic, and a second AI agent rigorously checks that code against the exact parameters. When constrained, it works.
But wait. Let's say I concede that an MCP server fixes the syntax errors. You are completely ignoring the mathematical reality of what the AI is actually doing with that code.
Meaning?
A script compiling without errors is not the same thing as a script generating alpha. What the AI is actually doing is just automating backtest overfitting. Let's go back to that viral Claude strategy we mentioned in the introduction.
The 233% return one.
Yes. It looked like the holy grail, but when quantitative developers reverse engineered it, they realized the AI didn't discover a hidden edge. It just executed a massive grid search.
Right. It brute forced the parameters.
Precisely. For the listeners, grid optimization is a brute force mathematical process. The AI wrote a basic strategy and then ran it through 240 different combinations of parameters.
Testing every moving average a length.
Every moving average, every confirmation threshold, every hold time. It just overlaid all those combinations on historical data until it found the exact mathematical path that dodged every past market crash. It's curve fitting in its purest form.
It is, yeah.
It's like a student stealing an exam's answer key. They memorize that question 1 is C and question 2 is A. They score 100% on that test, but if you give them a different test the next day, they fail because they never learn the mechanics.
I don't disagree that grid optimization is a trap. A perfectly smooth, upward-sloping equity curve in a backtest is always highly suspicious. But data snooping doesn't invalidate the LLM. It just means the human validator needs to apply walk-forward analysis, or WFA.
Walk-forward analysis. Sure, the academic standard.
Exactly. You don't just run a single historical test. You take your data block, say 2 years of market history, and optimize the strategy there. That's your in-sample data.
Where the AI memorizes the test.
Right. But then you freeze the parameters. No code changes. You run that exact strategy on the next 6 months of unseen data. That is your out-of-sample test. Then you slide that window forward. If the AI was just curve fitting, it falls apart immediately.
And it usually does fall apart.
Often it does, and then you discard it. You also check for parameter sensitivity. If changing a moving average from 14 days to 15 days causes a massive performance cliff, you know the model is fragile.
The AI's job is to rapidly generate the hypothesis. The human using walk-forward analysis is what proves the edge.
That makes sense in theory, but it assumes market conditions cycle predictably. If an AI strategy somehow survives WFA, how does it fare over decades of live, shifting market regimes?
You're bringing up the Finfluencers framework study.
I am. The Finfluencers researchers critically assessed LLM timing-based strategies over 2 decades, across more than 100 different symbols, and they exposed a severe deterioration in performance. The model severely underperformed passive benchmarks in bull markets by being too conservative.
Right.
And worse, they incurred heavy losses by being overly aggressive in bear markets. Because they lack regime-aware risk controls, they suffer from context rot.
Context rot related to attention mechanisms?
Exactly. The AI uses attention weights to decide what parts of your prompt matter. If you feed it strict risk rules, followed by years of volatile data, that attention gets diluted. It mathematically cannot hold on to its system instructions while processing a shifting macroeconomic environment. It loses the thread.
That's an interesting point, though I would frame it differently. The context rot limitation was real, but API developments are already solving it. We now have cache-aware input tokens, or ITPM.
Which is mostly for reducing developer compute costs.
It reduces costs, yes, but functionally, it rewrites how much context the model can hold. Normally, the model recalculates attention weights for every word, every time. That causes the dilution. But with ITPM, cache tokens don't count toward rate limits.
So it holds a pre-computed state.
Exactly. If you hit an 80% cache hit rate, you can process up to 10 million total input tokens per minute.
Wow, 10 million.
It is immense. The AI doesn't have to spread its attention thin and forget instructions. It can hold the entire prompt history, the regime-aware risk controls, and the real-time data simultaneously.
The mechanics of cache-aware tokens are impressive, I'll give you that. But you are describing a highly sophisticated quantitative developer. We have to look at how this is actually being deployed to the public. Right now, the illusion of AI superiority is weaponized.
You're referring to the scam ecosystem.
The National Anti-Scam Center data, nearly $1 billion lost in a single year. 945 million to be exact. Scammers are using deepfakes of public figures like Andrew Twiggy Forrest and Gina Reinhart to push fake AI trading bots.
A6 takedowns.
Yes, ASIC had to shut down over 330 of these sites. The theoretical debate over token limits feels pretty disconnected when the technology is acting as a black box to defraud retirees.
The fraud is devastating, absolutely. I support ASIC's stop, check, protect framework completely. But we have to separate the existence of the scam ecosystem from the utility of the tool itself.
How can you separate them when the tool enables the scam to scale?
Because the mechanism of fraud isn't new. Scammers use clickbait to push fake superannuation schemes, but that doesn't make superannuation a scam. But even moving past outright fraud, let's look at the legal Finfluencers.
The legal side isn't much better. Look at the Nordic platform study.
I was just going to bring that up.
Researchers analyzed a massive European social trading platform with 11 billion euros in assets, and they found that platform-affiliated Finfluencers deliberately adopted strategies that generated exceptionally high trading volumes.
To generate brokerage commissions.
Right. The platforms make money on the bid-ask spread and fees, so the influencers push noise and speculative short-term trading instead of sound advice. They're farming followers for commissions, using AI to wrap it in a pretty, code-heavy dashboard.
But the conflict of interest is real. But there is a second half to that Nordic study that upends the narrative that retail traders just blindly copy these influencers. The data showed followers are actually incredibly economically rational.
Rational? They're in a system designed to harvest their fees.
But they adapt. The researchers looked at the platform's ranking system, graded by Sharpe ratio.
The measure of risk-adjusted return.
Exactly. Over time, followers actively gravitated toward long-term rational Finfluencers, the ones focusing on fundamental asset value. The short-term rational Finfluencers pushing speculative arbitrage were systematically abandoned.
But couldn't that just be correlation? Maybe the followers who joined during a bull market naturally preferred long-term holding.
That is exactly what the researchers ruled out. To prove causality and avoid endogeneity, the idea that they just share a market bias, they used an instrumental variable.
Right, let's explain the mechanics of that because it is a brilliant way to isolate behavior.
It really is. So they looked at new users who were randomly assigned to follow platform employees by the algorithm. Because it was completely random, it acted as a pure control group.
So their prior preferences didn't matter.
Exactly. And they found that pure, random exposure to high-quality, long-term influencers actually improved the retail investors' portfolios over time. They actively select for actual risk-adjusted performance. AI as an analytical engine just allows the retail trader to measure and execute that performance themselves.
I don't dispute the mathematical elegance of the instrumental variable approach, but I firmly dispute the idea that AI provides clarity for the average user. We are talking about an architecture designed to be pleasing. If a trader wants a 200% return, the LLM will build a grid-optimized dashboard to confirm that bias.
Accelerating overfitting.
It accelerates overfitting, it hallucinates syntax, and it structurally fails to navigate macroeconomic shifts due to context rot. It is inherently dangerous because it cloaks extreme fragility in the aesthetic of advanced mathematics.
And I would summarize my position by saying that the fragility you are describing is a product of poor frameworks, not a permanent technological ceiling. When a trader enforces strict constraints, uses an MCP server, and actively monitors the reality gap with walk-forward analysis, AI is profoundly useful. It finally bridges the coding gap for retail quantitative traders.
Well, we do have one area of complete convergence.
The danger of black box autonomous trading.
Absolutely. Handing over full, unmonitored execution autonomy to an algorithm is a recipe for disaster. The precedents are carved in stone. Look at long-term capital management in 1998, collapsing because models couldn't predict human panic.
Or Knight Capital in 2012.
Right. A single faulty algorithm wiped out $440 million in 45 minutes. If institutional capital can evaporate that fast, a retail investor handing their savings to an autonomous LLM is committing financial suicide.
We are in total agreement there. A human must always remain in the loop. The disagreement remains on whether these tools can possess true structural alpha, or if they are permanently confined to being statistical curve fitters.
Which leaves us reflecting on the profound complexity of the modern retail trading environment. As API token limits expand into the tens of millions, the line between an invaluable research assistant and a dangerous financial hallucination is only going to get thinner.
It will require constant critical evaluation. A perfectly smooth equity curve generated in a 10-minute backtest is easy to produce. But the true test of this technology lies in rigorous, out-of-sample, live testing. We leave it to you, the listener, to determine if your analytical framework is robust enough to handle that reality gap. Thank you for joining us on The Debate.